Hi, Tasty Nation, Investor Nation, and anyone who wants to learn more about how to survive a Black Swan event and even profit from a Black Swan event. So a Black Swan event is supposed to happen in theory about once in a lifetime, but actually in practice, we've been seeing it happen more like once in a decade. So I'm the Canadian options trader, also known as DrZ, and I've come up with a trade called the DrZ Black Swan Hedge. Now, some of these ideas I got from Uncle Tony over at the Tony is Trading channel, and also from Sweet Bobby over at the Sweet Bobby channel. He has a trade called the Sweet Bobby Hedge. And both of these guys, I believe, pulled a lot of their hedging strategy from Ron Bertino's work. And I've also had many discussions about this with Uncle Tony, as well as some of my other Canadian trader friends over the last year or two. So personally, I don't like the idea of spending money to hedge my account for a Black Swan event. But if I could buy a very cheap lottery ticket, knowing that in the next decade or so, when the shit hits the fan, as long as I'm diligent and keep putting that trade on over and over, I can profit from that Black Swan event. Well, first of all, what is a Black Swan event? If we go over to TastyLive, they have a free backtester. Just go to lookback.tastylive.com, sign in with your email address, and then click Start Now, and you'll get to the backtester. I've typed in SPY, which is the S&P 500 ETF as my underlying, and I'm going to go and do an advanced back test of naked short puts. So as an example, using the regular Tasty trade mechanics, starting at 45 days to expiration, if I was to short a 30 delta put and do that every cycle and run the back test, this is data collected from 2006 to present day. So this is about 18 years worth of options data. You can see that the result I get is a win rate of 88%. And I'm getting a positive expectancy here. So profit per trade, $85 a trade. So this is a winning strategy over those 18 years. But look at the largest loss here. This is a huge drawdown in February 2020. So what happened in February 2020? So here I have a SPY chart on the right side here. So this giant dip right here from February 14 to March 20th in 2020, we had a market crash of 32% in just a month. So that is what we call a Black Swan event. No one saw that coming. You couldn't really prepare for that. I wish I had on a Black Swan hedge during that time, but I didn't. So hopefully I learned from that experience. But I've heard from Uncle Tony and Sweet Bobby, they both did have on a Black Swan hedge during that time. So congratulations to them. Hopefully we can learn from their experience. So what happened to the VIX during that time? Well, the VIX right now is trading very low, only at around 13. But look what happened in February 2020. The VIX spiked around 300% in that same time period. So that is, again, a Black Swan event. When the VIX goes from very low to very high, all in a short period of time, that's a Black Swan event. It was unexpected, and there's panic in the market. Now, I remember actually VIX going to 80 during that time. Google Finance here only has it going up to 65 or so. And then if I go and zoom out in time to the max for the VIX, which is the CBOE volatility index, so that was the spike there in 2020. The last time we had a spike that high was in 2008. So that was another Black Swan event. 2008 and 2020, we definitely had Black Swan events. 2008 was way before I started trading, so I didn't really experience that. But this is something we can expect every decade or so. We're going to have these huge spikes in volatility. And by the way, when the VIX goes to 80 or so, that means that the market is expecting a move of around 80% in the next year. So 80% volatility in the market is huge. It only happens once a decade. So that largest loss, that's what happens in a Black Swan event. You can lose big if you have on short options. So the Tasty Trade Mechanics says that we should close our short options at around 21 DTE to help reduce some of that outlier risk. So if I rerun that simulation, closing early at 21 days to expiration, you still get a positive expectancy for the trade, but there's still a large loss there of $5,000. So you're only making about $53 on average per trade, but you're losing 100 times that amount in the Black Swan event. So even though closing early can protect ourselves from the outlier events, these extreme outlier events, the Black Swan events, can still cause big problems for us. So one way of dealing with that is you could define your risks. So if I was, for example, to buy a 10 delta put to hedge my exposure, so to speak, and rerun that back test. So here, it's still a profitable trade. My largest loss was reduced, so only $3,400 largest loss there. So that is one way to hedge, by defining your risk with a far out of the money put. But I'm looking to go farther than that. My philosophy is I want to try and profit when we have a crash. When the shit hits the fan, everyone's panicking. I want to have on a position that will actually profit. And by the way, these mechanics of opening a trade at 45 days to expiration and closing it or rolling it at 21 days to expiration, that comes from the regular Tasty Trade mechanics. And I covered all that in my video called the Tasty Trade Mechanics on 2 sheets. So check that out if you haven't seen that. So here I am in my trading platform. I'm still patiently awaiting for Tasty Trade to come to Canada. So right now I'm stuck using Interactive Brokers, but I'll go through a sample DrZ Black Swan Hedge using SPY to start with. So I'll expand the options chain here, and I'm looking at around 50 days to expiration. February 16th is the expiration date, and I'm going to start by selling a 30 delta put. So the 466 put, the margin impact to sell that put is $6,500. So that gives you an indication of the kind of risk you're taking to do that trade. But I'm going to define my risk at the 10 delta. So buy the 441 put. That reduces my buying power usage to $2,100. And I can do that trade for around almost $3 credit. So what I'm going to do is, that's just selling a put spread, but I'm going to use the credit on that put spread to go far out of the money and buy a shitload of long puts as my hedge. So one of the strategies here for the DrZ Black Swan Hedge is to have a lot more longs than we have shorts. So with a credit of $3, I can buy, say, the 380 put trading at 30 cents or so, but I can buy 10 of them and use up that credit. So I'm doing that whole trade for around even. The margin impact or the buying power has dropped down to $641. So this is a lower risk trade than not having on those extra 10 puts. And then if I look at the risk profile of this trade, the dotted line shows the risk profile today, and the solid line shows the risk profile at expiration. So if we crash today 10%, I would make $790 on that trade. If we crash 20%, it would be more like 12 or 13,000. But if we crash 30%, it would be 45,000. So this trade explodes if we crash quickly because of all those long puts I have far to the money. So those longs that I bought happen to be at the 1.5 delta. So that's today, but that's not really realistic that a crash would happen the same day I put on the trade. So if we go out in time a little bit, you can see what happens is the dotted line gets closer to the solid line. And as we get to expiration day, February 16th, the dotted line becomes the solid line. And we call this valley here the valley of death. So we want to avoid the valley of death. And the way we do that is, for my short put here, I'm still going to make sure I close that at 21 days to expiration, right? So if I back up 21 days from February 16th, that's around January 27th. So I can avoid that valley of death as long as I close that short put at my usual 21 days. And then I can leave the longs on if I want and give me that black swan protection there. So we call this droopage. The dotted line is drooping into the valley of death. So we can avoid that droopage by closing the short early. So I could go ahead and submit this order and fill that trade, but there's a reason why I chose to buy 10 here. I don't actually have to buy 10 SPY puts. If I'm buying 10 380 puts in SPY, what I can do first is get rid of that one, just fill the short put spread first for around a $3 credit, then go over to SPX, which is 10 times the size of SPY, and just buy one of those equivalent puts. So in the same expiration, 52 days to expiration, I can go far to the money and use that $3 to buy just one put in SPX. So this one happens to be at the 1.6 delta, the 3840 put, and I can do that for the credit I received on the short put spread. So the margin impact is negligible here. So that's one way to do the DrZ Black Swan Hedge, but that's not the way I would do it. I would instead use futures. I love using MES, the S&P micro futures. So I did a video called Mini versus Micro Futures. So check out that if you haven't seen that yet. And I'm going to do the same thing now in MES. And by the way, I already have a position here in MES, but I'm going to sell around the 30 delta, the 4,700 put, expand this out a bit, and then buy around the 10 delta, the 4,440 put. And I can do that for 31.5 points credit, and then go far to the money. This is just the simulating part, to buy 10 puts for that same credit. So say around the 38.50, buy 10 of those just in order to see my profile here, to see my risk profile. So again, it's the same sort of graph. If we crash today, it'll do well. But if it happened further out in time, say just before 21 days to expiration, it will profit big if we crash. Now, one thing that my trading platform here cannot do is I can't show what happens when volatility spikes. So VIX is only trading at 13 right now, but what if VIX spikes to 20? Well, what you would expect is this dotted line would jump up a little bit because all the options increase in price when volatility goes up. But then if it increases, say, to 30, that dotted line would go up even more. And if the VIX increased to 40, that dotted line would go up even higher. So you can avoid that valley of death also when VIX spikes. So as a Black Swan hedge trade, this actually would work pretty well. And you can avoid that valley of death when volatility spikes. Now, on the other hand, if volatility doesn't spike and we have just a slow, steady grind down, a slow bear market, this trade wouldn't do very well. But also, it's not going to cost that much. I'm trying to make this to be a low-cost trade. So even if it ends up losing a little bit, I'm not going to be too concerned. And as long as I get to profit big when we really do have a crash. Okay, so I'm not going to fill this version. What I'm going to do is I'm going to take off those 10 long puts. So I'm going to sell just the short put spread first, collect a credit of around 31 points. My margin impact on that is pretty much negligible. Of course, this is span margining, which takes into account my other futures positions. Submit that order, try and fill that, and then pop over to ES, the mini S&P futures, which is 10 times the size of MES, and go down to the same strike that I was looking at in MES for my far to the money put. So around the 38.50, I can buy that one for around 3 points. So the multiplier on ES is 50 and the multiplier in MES is 5. So basically I'm doing this trade now for even and relying on the heavy part of this trade is this long put here that would spike up in a crash. So I wanted to show how I came up with this line of thinking for the DrZ Black Swan Hedge. And going back to the LookBack backtester here, I realized that if I'm always rolling my trades at 21 days to expiration, that means I'm actually putting them on at around 50 days to expiration. It's a little different every cycle, but average of 50 days. So if I rerun my back test on the short put spread, going from 50 days to expiration to 21 days to expiration, I'm getting a profit per trade of $35.73 on average. And I can use that credit to buy my far to the money long puts. But what I'm going to do here is I'm going to break up this back test into two separate back tests. I'm going to keep my short put on the left side of the screen, and I'm going to do my long puts on the right side of the screen. So I'm going to go long 1 10 delta put here and long 10, roughly 1 delta put for my far to the money puts that I'm buying. And if I run my back test, again, just a naked short put on the left-hand side and my longs on the right-hand side, you can see the result I get is my short put loses that $5,000 in February 2020, but my longs make $55,000 at that same time. So the long puts kick in exactly when I need them in the Black Swan event. Now the profit per trade on the longs is negative though. So this trade has a negative expectancy. So that means it's actually costing me over time, even though I get that big win in February 2020, over time, this will cost me money. But I'm making up for that with the profit I'm getting on the naked short put on the left side here. But then there's another thing I can do is, what if I harvest my long puts at a certain percentage? So when my long puts are winning big, I can close them out for a profit. And at that time, I would definitely make sure my short put is closed out. So for example, if I took profits at something huge like 5,000%. So that means I'm taking profits at 50 times what I paid for the debit for these 11 puts. Well, it turns out that I'm still getting a huge profit in February 2020 in the Black Swan event, but I'm actually getting a positive expectancy on this trade. So this is a winning trade as well. And I don't necessarily have to close these puts early. I can leave these on. I want to close my short put early at 21 days to expiration, but I can keep my long puts on until they profit big. I tried a few different variations of this. For example, I actually noticed that if you close these puts at, say, 14 days to expiration and rerun that, I can still end up with a positive expectancy on this trade. So that means I'm taking profits at 50 times what I paid for them, or closing them anyway at 14 days to expiration. I think probably at 14 days to expiration, those long puts probably won't help that much anyway. So if I make sure those are closed out, at least it'll keep a little bit of extra profit in my pocket. So we call that harvesting the longs. I want to harvest my longs when they're winning big or just close them out at 14 days. So I think this is about as close as I can get to owning a lottery ticket for free or almost free. So now if we put all these legs together into one simulation, the short put at the 30 delta, the long put at the 10 delta, and 10 long puts at around the 1 delta, keeping pretty close to the same parameters, and run that whole back test all together in one package. Let's see if that trade has a positive expectancy. And it does. The net win is small. It wins huge, though, in the Black Swan event. And the largest loss is something that is pretty manageable. For some reason, that ended up being in May 2022, so I'm not sure what happened there. But then the other thing we can do with LookBack is LookBack has this thing called a simulation, and I can run the same simulation doing an actual trade right now. So if I go to the February 16th expiration, 52 days to expiration, and I sell around the 30 delta put and I buy around the 10 delta put, I'm getting a credit right now of $279 on that. This is using SPY. So then I can go far to the money and use that credit to buy 10 of these puts around the 1.5 delta, and then look at the simulated results looking forward in time now, not back testing. This is looking forward in time. And you can see the same kind of curve that I was showing in my trading platform. The blue curve is right today, and the yellow curve is at expiration. And I can slide this slider here to advance the dates. So around 21 days to expiration, I'm getting that droopage there. So I also can't really simulate in this free software what happens when volatility spikes here. So I would expect that blue curve to move way up in a volatility spike. So I can try to avoid that valley of death there before the crash happens. But when the crash happens, you make that back. But that's my trade. So let's do a summary here. The DrZ Black Swan Hedge trade. I'm opening a new trade at around 50 days to expiration. I'm selling a put in /MES at around the 30 delta. I'm buying a put also in MES at around the 10 delta. And then I'm using that credit to buy one put in /ES at around the 1 delta or so, basically using that whole credit from the short put spread to buy my far to the money put in ES and try to do that whole trade for around net even. So my trade plan is to always close my short put at 21 days to expiration to avoid most of the outlier risk, and then harvest my longs at around 50 times what I paid for them, or close them out at around 14 days to expiration, something like that. So that's my trade. I'm going to keep doing this every cycle from now for the next decade. So I'll report in the next decade and let you know how it worked out. Hopefully I hit it big one of these days, and hopefully you learned something from this discussion. Okay, well, thanks for watching. Please let me know, do you do any kind of hedging in your account? Do you have your own version of a Black Swan Hedge trade? Or do you do some of the other ones that I mentioned earlier? Also, anyone that has OptionNet Explorer, also called ONE. I don't have that software, but if you want to put my trade into your software, let me know what happens in the different scenarios where the volatility spikes or it doesn't spike. Let me know, do you think my trade is reasonable going forward? Am I going to lose on it over time? Am I going to win over time? I really have a hunch that it's a winning trade over time, as long as I have it on when the crash happens. The worst thing to do is to go through the mechanics of doing this and then forget to put it on one cycle, and that's the cycle that we have the crash. I got to keep this up and be very diligent in putting this trade on. Okay, well, thanks for watching, and hopefully you and I both profit in the next Black Swan event. Thanks for watching.